Hello and welcome to this module on conventional non-conforming loans. Let's do a conventional loans overview. Conventional loans are mortgages not part of a specific government program. These are private programs and they're not government insured or backed. There are two categories of conventional loans that you need to be familiar with: conventional conforming loans and conventional non-conforming loans. Conventional conforming loans conform to the standards of Fannie Mae and Freddie Mac. However, conventional non-conforming loans do not conform to the standards of Fannie Mae and Freddie Mac. So let's discuss Fannie Mae and Freddie Mac in brief. Fannie Mae is also known as the Federal National Mortgage Association, or the FNMA, and Freddie Mac is also known as the Federal Home Loan Mortgage Corporation, or the FHLMC. Both are government-sponsored enterprises, or GSEs, and they function to expand the secondary mortgage marketplace, and they securitize mortgage loans in the form of mortgage-backed securities, or MBSs. Let's talk about conventional non-conforming loans. Conventional non-conforming loans do not conform to the standards of Fannie Mae and Freddie Mac, and examples of conventional non-conforming loans include the following. They include jumbo loans, subprime mortgages, Alt-A loans, hard money loans, and purchase money mortgages. Let's talk about jumbo loans. A jumbo loan is a type of mortgage exceeding the loan limits set by the Federal Housing Finance Agency, or the FHFA. These are non-conforming because the loan amount is above Fannie Mae and Freddie Mac loan limits. Now, jumbo loans require a high credit score, generally speaking 700 or above, but it varies by lender. They also require a low DTI, generally less than 43% total DTI, but it does vary by lender. Jumbo loans require a higher down payment than conforming loans. It can be, however, as low as 10 to 15% down payment, and again, this varies by lender. This in mind, let's talk about the FHFA loan limits. The Federal Housing Finance Agency, or the FHFA, sets loan limits for Fannie Mae and Freddie Mac. Now, the baseline conforming limit for 2023 is $726,200 for a one-unit property. It's higher in Alaska and Hawaii, so for a one-unit property, it's $1,089,300. And the FHFA sets higher loan limits for high-cost areas. So what we discussed so far were the baseline conforming limits. For high-cost areas, there are higher loan limits set by FHFA. Now, homes that exceed the FHFA limits require a jumbo loan, and jumbo loans are more difficult to qualify for. Another type of a non-conforming conventional loan is the subprime mortgage. It's available for those with lower credit scores. And credit scores for subprime borrowers are generally less than 600. They require a larger down payment, and they feature higher interest rates than conforming loans. Another type of a non-conforming conventional loan is an Alt-A loan. Now, these are non-conforming because the borrower is unable to provide sufficient documentation requirements. So these loans require less verification of income and assets. And types of Alt-A loans include the following. They include no income, no assets loans, also known as NINA loans. These are loans in which the income and asset documentations are not provided. They include no income verified assets loans. These are called NIVA loans. And these are loans in which the income is not provided but the assets are verified. They also include stated income verified assets loans, or SIVA loans, and these are loans in which the income is stated and the assets are verified. They also include stated income stated asset loans, or SISA loans, and these are loans where the income and assets are stated but not verified. Another type of a non-conforming conventional loan is a hard money mortgage. Now, the lender approves the borrower based on the value of the property for a hard money mortgage. And hard money mortgages are sought by property flippers. They require a lower LTV, so they're a bit more expensive. The LTV could be as low as 50 to 70%, so you can imagine that the down payment is going to be quite high for a hard money mortgage. So a significant down payment is required for these types of mortgages. And a hard money mortgage can't be obtained from a traditional lender. Lending is acquired from private companies and not traditional lenders. Now, hard money mortgages feature a fast and easier approval process, generally within days. And a short repayment period is generally expected for a hard money mortgage. So these mortgages are expected to be paid off faster. Remember, these are used by property flippers who are going to flip the property and pay off the mortgage soon. Let's talk about purchase money mortgages, which is a type of non-conforming conventional loan. Now, this is a mortgage provided by the seller to the borrower or to the buyer. It's usually performed when the buyer cannot otherwise qualify. So, for example, the buyer could have a low credit score, they could have a high DTI, or they could have no assets for a significant down payment. Now, down payment and interest rate are set by the seller. And generally speaking, purchase money mortgages feature higher interest rates than traditional lending. Let's talk about land contracts under purchase money mortgages. Now, a land contract is a written legal agreement between the buyer and the seller. The seller finances the property for the borrower. And again, a land contract for a purchase money mortgage is usually performed when the buyer cannot otherwise qualify. For example, they have a low credit score, a high DTI, or no assets. Now, the down payment and interest rate are set by the seller, and generally these feature higher interest rates than traditional lending. The title is retained by the seller until the buyer pays off the final installment. And this concludes our module on conventional non-conforming loans.